So thank you everyone for attending today's webinar, Understanding Incorporation, What You Need to Know, hosted by doctors of BC Business Pathways in collaboration with MNP. Just a few housekeeping items. The session is on Zoom webinar format, so everyone's muted on entry. There'll be a 30-minute presentation followed by a 15-minute Q&A session. Please use the Q&A function on the Zoom toolbar or raise your hand if you have questions for our presenter. If you have any technical difficulties, please let me know via the chat function so I can assist. I'd like to begin by acknowledging the land which I reside on for this gathering is the unceded territory of Coast Salish peoples, including the territories of the Musqueam, Squamish, and Tsleil-Waututh nations. I know we're all from various locations around BC today, so I appreciate you all for being here and the land you're presently on. Business Pathways is a new initiative of Doctors of BC developed to support physicians with their business needs. We have recently fully launched our program in May. You'll find resources on the website for contingency planning, human resource toolkits, information on starting your practice all the way to closing it. On Doctors of BC Club MD session, you will find our regular incentives to businesses, but now you'll also find additional incentives like law firms, accountants, office supplies, and equipment for businesses at preferred rates. We're still in the initial stages of rolling out resources onto the website, so any feedback will be appreciated to help us move forward. In today's session, we will be guiding you through the process of incorporation and answering some common questions that often come up. Our presenter, Sean Howe, is well-versed in this area, and we're pleased to have him share his knowledge today. Sean is a partner with MNP's professional services team, and he specializes with working one-on-one with healthcare professionals to provide services such as tax planning and compliances, business advisory, assurance, practice transition, and general consulting services. This will ensure his clients' practice are efficient and organized so they can achieve their goals. And now I'll pass it on to Sean to go over today's topic. On to you, Sean.
Perfect. Thank you, Walter. So as Walter mentioned, I'm Sean, partner in MNP in our Langley office. A little bit of background on MNP. We are a national firm, so we have offices all across Canada and all throughout BC. And within MNP, we also have a group called our professionals niche, we call it. So there's a big group that focuses on doctors, dentists, and all other professionals. So whether your location is best suited in the Lower Mainland or elsewhere in BC or outside of BC, we can always find somebody that's able to help. So today we are going to talk about understanding incorporation, just kind of the high level of what to look out for. And now, before we really jump in, the one big thing I just want to point out is to be aware that everybody's situation is a little bit different. Not everybody has the same circumstances when it comes to income or personal cash needs or debt or goals long-term. So just know that whatever your situation is, it might not be the same as the person next to you. So it's important that we look at all these things independently. So today I'll go over kind of employment versus self-employment as you make a transition from residency to self-employed. We'll go over typical structures for physicians, whether it be self-employed proprietor or a corporation, why you would incorporate, when you should be looking at it, as well as some other topics such as setting up your corporation. So first off is just employee. So this is essentially what you would be during residency. You're going to receive your net pay. So the employer is going to withhold your tax, going to withhold your CPP, EI, and you're going to get a net paycheck. At the end of the year, your taxes are fairly simple. You're going to get a T4 slip and you report that. And in most cases, you're not going to have much of a balance owing or much of a refund, assuming all the taxes withheld properly. You might just get a big refund if you're using your tuition credit. So overall, employees not too complicated. It says no expense deductions, but really the only one that really comes up would be if you had college dues, for example, that aren't being reimbursed. And your main form of tax planning in this case is going to be RRSPs. So overall, there's not too much to consider as an employee. It's fairly basic. Now, once you finish residency, though, in most cases, you're going to become a self-employed individual. So what this means is that they're going to start, or your employer is going to start giving you 100% of the income you earn. So no tax is going to be deducted, no CPP, no EI. You're just going to get 100%, and then you're going to be responsible for tracking what your income is, tracking what your expenses are, and remitting or recording all of that on your personal return each year. Big thing to note here, though, is just being prepared for that tax bill because no tax is being withheld. It's likely in your first year and in future years that you're going to have a balance owing at the end of the year as a self-employed individual. Even if you do have tuition credits available and carried forward and that weren't used during residency, it's likely you're still going to have a balance owing for CPP. When it comes to EI, in most cases, you wouldn't be eligible. You're not paying into it. There is an option to opt into EI, but I would recommend having a conversation prior to proceeding with that, just because it can have some long-term implications. As self-employed, you are able to deduct your business expenses. So I'll have a laundry list of those general expenses at the end of the presentation, but from a high level, it's going to be, are you incurring any costs in order to do your job or to earn your income? If so, you'd be able to deduct those. And then with self-employed, because it gets reported on your personal return, it's all done on a calendar year basis. So January to December. Okay. And sorry, just going back to that one, if on the self-employed, if you had any questions about how much you think you might owe at the end of the year, just let us know or let your accountant know. And in most cases, we can run a tax estimate for you to at least give you a rough idea how much you're going to be owing in April, especially if this is going to be your first year being self-employed. Now, looking at the different legal forms of how you would operate, first is basically self-employed, but it's called a proprietorship. So it's not a separate legal entity. It's really just you're operating under your individual name. It's within your individual bank accounts. This is most commonly used for new doctors before incorporation, or if you're deferring incorporation due to personal debt or goals. It's normally a case of when you're going to incorporate, not if. It's unusual for full medical practices to continue to run as a proprietorship, albeit it does happen sometimes if you don't meet any of the criteria or reasons why you would in the future slides. And then these proprietorships are simply taxed under your personal name. So you're going to pay tax at all the marginal rates leading up, with the highest one being about 53.5% once you cross 220,000 of income. Okay. So your next option then is to incorporate, which is when you would create a professional corporation. So this is by far the most common structure. And like I said before, it's typically a matter of when you will incorporate, not if. In cases like this, the professional corporation is its own separate entity. It has its own bank accounts, it has its own credit cards, its own filings. And in this case, the physician would typically own 100% of the voting shares, just because that's required by the college. But you could have other non-voting shareholders, such as yourself, your spouse. You could have family members or a family trust. Just depends on your specific circumstances what makes the most sense for you. So if you were to set up the corporation is now going to own all of the medical assets, so any equipment. It's also going to own all the medical activities. So any of your billings will go through here. Any of your expenses will come out of here. And it's going to run basically the practice in itself. Okay. As for tax rates, in most cases, your first 500,000 is going to be taxed at 11%. Now, there are situations where that can be different, where say you're part of a group practice, or your income's over 500,000, or you're associated with other corporations. So these are things we typically cover off in an initial one-on-one chat, just to see if there are any other implications that would change that. For a professional corporation, unlike a proprietorship or employee, you can choose your own year end. So instead of doing January to December, you can really pick any 12-month period. Most common ones that are picked would still be January to December, just to match personal, or you pick basically 12 months out from your incorporation date so that you can defer any filings or taxes for as long as possible. And one more thing to note here on the professional corporation, it's more of a legal issue, but there's typically no limited liability for malpractice. So in some types of corporations, you can have limited liability and have a bit of protection from a corporation. But as a professional, if you were to be sued or anything for malpractice, typically they're going to go after you as the individual still. Okay. So now that we've kind of gone over the different structures, the big question comes up is, should you incorporate, or why should you incorporate? So like anything, there's pros and cons to going down that route. And I'll go through the pros in more detail just to walk through what I mean on each of them. But the main advantages are going to be either tax deferral or permanent savings. The potential for income splitting, albeit it's a lot more difficult to do so now since rule changes in 2018. And the ease of budgeting yourself, just because it is a separate legal entity. It has, you can have the separation between your personal account and your company account. Disadvantages are obviously part of it being its own separate legal entity. It has its own paperwork, like its own bank account, its own credit card, has its own tax filing, financial statements, and all that increased paperwork typically leads to increased legal and accounting fees as well to keep the corporation up and running and in good standing. So the big thing to take away though is if you're not getting any of the advantages, then really a corporation is just costs without the benefit. So that's why we really want to know, if you're going to incorporate, why are you going to incorporate and what benefits are you receiving from it? So that's typically the starting point for any of these conversations, is to pinpoint exactly why it makes sense for you. So when should you be looking at incorporating? So there's three main criteria I would typically go through when deciding. So first is income splitting. Like I mentioned before, it's a lot more difficult now, but at least going through that checklist to say, is there an option to income split? Like, will your spouse be active in the business? Will income splitting be available well into the future in retirement? What are the options here? Are you going to be purchasing a commercial property or a rental property, or buying into a clinic? Because you can pay off the debt a lot cheaper with the after-tax corporate dollars than you would be able to with personal. And again, I'll go through those examples. Just to clarify the purchasing of property though, I wouldn't buy your principal residence through here. This would be more if you were using it for a clinic or using it for rental. And then the most common one, so that where it usually comes down to for a physician to incorporate, is, are your earnings greater than the amount you need to live? So that's what then comes up, tax deferral and potentially tax savings. So that's typically where most of the conversations go and end up, is people are earning more than they actually need to live, and they want a vehicle to save for retirement. So how can your professional corporation save you money? So there's two different things we want to look at here. There's tax savings, which is going to be a permanent tax savings where you are able to get the money out to your individual name, paying less tax than you would have as self-employed. You're never going to have to pay that. You actually had permanent savings. The next is what's called tax deferral, meaning you're not going to pay the tax now, but you will likely have to pay the tax in the future. It's just deferring when you're paying it. Okay. So looking at each of those, deferral is basically with your personal tax rate, you're paying up to 53.5%, whereas in a corporation, you could be paying 11% upfront. So when we're looking at deferral, we're saying if you had $100,000 of excess earnings, so say for example, you're earning 350,000, but you only need 250,000 to live personally. That extra $100,000, as self-employed individual, you're going to pay 53,500 of tax and be left with 46,500 to invest. But if that was in a company, you're only going to pay 11,000 of tax and have 89,000 left to invest. So that in itself is obviously cash flow savings upfront. But then when you reinvest that money up more and you get the 5% return estimate over 25 years, you can see how the compounding on that extra money can create a much bigger nest egg for you in retirement. Okay, so that's kind of the goal of deferring, because you're making money off that money that's in your hands instead of the government's. Now, you will have to pay tax when you take that out personally in the future, but permanent tax savings can occur when you take that money out when your income is lower. So yeah, as an active physician, maybe your income's 350, but in retirement, maybe you're only making 100 or only taking 100. Now you're paying a lower marginal rate on that. So you are actually getting permanent tax savings there. So this is a bit of a complicated one, but overall, this is the benefit you're receiving if you are earning more money than you need for your personal living. Now, just to look at another example on this, this is one where you're making 250,000, but you only need 10,000 a month after tax to live. As an unincorporated professional, you'd have about 41,000 left to invest in your personal name. But if you were incorporated and went that route, you could have up to 66,000 in the corporation. So that extra 25,000 would be your deferral in this case, and allow you to invest it and create more additional income and compound. So then looking at dividing, so I won't go too much into this because like I said before, the tax system has got more complex with income splitting, where it's much more difficult to do it, and it has to be reasonable in nature for any income splitting you are doing. So from a high level, income splitting, the benefit you receive is that individuals in Canada are taxed at marginal rates based on their income. So if you have a couple where each person is earning $60,000, you're going to pay less tax and have higher net in your bank account than if you had one person making 120 and the other was zero. And that's just because of the use of the marginal brackets and paying less. So looking at the example here on income splitting, you can see how this family basically makes 280,000, but because in one it's 250 and 30 as opposed to 140 each, you could save up to $14,000 with proper income splitting if you meet the criteria and are eligible. So this would be a permanent tax savings because you've got it out into your personal name and you paid less tax to do it. But I alluded to it before, but the income splitting changes. So these came back out in 2018. So prior to that, we had a lot more freedom. But now it really comes down to a couple different things. So there's a list here, but the big questions we'd ask is the spouse going to be active at all in the business? Can we justify a wage or can we justify a dividend for the work or value they're providing to the company? So that's going to be step one. We would kind of go down that route to see if there's anything they can do. The next one that we want to really look at here is when a doctor turns 65. So once the main shareholder, the doctor, turns 65, we can freely income split with their spouse again. So in a lot of cases, what we do is we don't necessarily have income splitting throughout the career, but you would have the spouse as a shareholder, build up the nest egg in the company. And then in retirement, we would freely income split, which that would create the permanent tax savings because you're not taking the money out when you're in the top tax bracket and you're splitting in retirement, which is creating even lower marginal rates. You'll see there are a few other criteria there, but they're getting more into specific situations at that point. So a lot of this would come up in a conversation one-on-one when deciding whether or not it makes sense to incorporate. So the next one would be, are you going to be financing a building purchase or buying into a clinic or anything like that? So this is an example of if you needed $1 million to pay down the mortgage or buy the property outright, how much money do you need to earn upfront to have that money available? So if you bought it in a company, you'd need to earn just over 1.1 million, pay your tax at 11%, to end up with your $1 million of after-tax money to buy the property. For the same situation on the far right, the personal side, you'd have to earn about 2,150,000 to do the same thing because you'd have to pay a much higher tax rate upfront to have that after-tax money available. Okay, so there are some tax deductions available when buying the property, but those would be typically realized over a longer period of time and wouldn't necessarily help with the upfront purchase. So this is another situation where we'd look at, does an incorporation make sense? And we may also go down the route of, does a holding company make sense if you already have a professional corporation? Okay. Now, so those are kind of the main reasons or main things we would look at when deciding if it makes sense to incorporate. So we would typically on a call go through the checklist. And in one of those, if you were ready to incorporate, we'd be able to pinpoint this is the benefit you're going to receive through having a corporation as opposed to staying self-employed. And it should be clear what benefit you're getting and why you're incorporating before you actually proceed. Just one more budget change. So when they changed the income splitting rules, they also came out with a budget change on what's called passive income. So how much investment income can you have in your company? Now, as a newly incorporated physician, this likely won't impact you for some time. But once your investment income starts to cross $50,000 a year, that's when it starts to impact your ability to access that 11% tax rate. So I won't spend too much time because I imagine most people are on the deciding whether or not to incorporate. But just something to know for the long term is as you start building up more and more investment income, you may get pushed towards paying 27% tax rate on some of your income, as opposed to the 11% we had talked about before. Still a big deferral compared to the 53.5, but just something to be aware of. And we would certainly go through that if you were approaching that amount in your corporations. Okay, so now you've gone through the process, you've gone through your checklist, you've said, okay, this is why I want to incorporate. I'm going to be able to defer income and save tax and build up retirements, or whatever reasoning it is that ends up being for you. What is the process for setting up the corporation? So typically you would start with talking to the accountant to go through that checklist, decide and make sure it makes sense, who would then be in touch with the lawyer to actually set up a corporation. So they would, the accountant would typically send instructions to the lawyer on the share structure and confirm that they want it set up. The lawyer would then take over, do the applications to the college. The big thing to note here is that recently we've been seeing it take about 4 to 6 months to actually fully incorporate a medical practice. So when looking at whether or not it makes sense, we really want to try and look into the future and say, if it might not make sense today, will it make sense 6 months from now? Because that's when it will actually be set up. And most of those delays are at the college level. And then it's just important to know that Walter and Business Pathways, they have different resources available as well, just to help out throughout the process. So once you've then gone to the accountant, they've sent the instructions, the lawyer has contacted the college, set up the corporation. Once that's fully done, it would then typically come back to the accountant where we would talk about setting up your business bank account, setting up credit cards, walking through how do you actually operate on a go-forward basis. Like, we want to make sure all the revenues, all the deposits are going into the company now, all expenses are coming out of the company, and how do we keep these very separate? Okay, so that's when a call to the accountant would typically come up again. And as part of that, we'd also complete the registration for your taxes, payroll if applicable, GST if applicable, and pick year ends and that type of thing. Okay, so basically kickstart the use of the corporation. Now, one thing we didn't talk about too much earlier, but if you happen to be a US citizen or green card, bring this up right away with the accountant when you're talking to them, because there can be some implications with the IRS on these filings. So you'd want to get in touch with a cross-border professional just to make sure you're fully aware of what those are, what the filing requirements would be if we're going to go ahead, because that would be one of those things that could change your mind. Okay, so one of the main questions we often get is what can I deduct either from self-employed or within my corporation? So from a high level, when you're looking at any expense, you want to ask yourself the question of, did I incur this expense for the benefit of the company, or did I incur this expense in order to earn income? If the answer is yes, then typically that's going to be a deduction, either against your personal name or against your corporation. Some general expenses we often see here would be your salary if you're on a salary, any of your professional dues or insurances, any training costs, phone, cell phone, general office supplies. Other ones we can see are business meals. So if you're going out with colleagues or it's a business related meal, you can write that off. The auto one is often a big question we get. It's a very specific ones, but what we often hear is, should I buy my car through the company or should I buy it personally? And how much can I expense? When it comes down to it, like, you really need to look, how much is my true business mileage? Keeping in mind that typically driving to and from work is personal, not business. So for when going into auto and the specifics of how you treat it, I would recommend having one-on-one conversations with your accountant, just because there are a lot of specific questions that need to be asked there. Okay. And then just keep in mind that any of your expenses need to be reasonable in nature and incurred to earn income. That's kind of the general guideline. Now, another big question we get after incorporation is, do I take a salary or do I take a dividend? There's often a lot of confusion here, mainly around the tax rates. You'll hear a lot of people say, well, dividends are taxed lower or are more tax beneficial. And you'll other people say salaries are expensive, that type of thing. But it's important to note that salary does have a higher personal tax rate. So you do pay more tax personally, but it's a deduction for the company. So you're paying less tax at the corporate level. Whereas a dividend, you pay less tax personally, but you are paying corporate tax first. So on a flow through basis, without looking at CPP, you're paying about the same amount of tax, whether you go dividend or salary. Now, other things, so salary, one, you have to pay CPP contributions, both employer and employee portions. You make regular remittances, just like with your T4 you're receiving, the CPP and tax gets paid directly to the CRA. And salary generates RRSP room, whereas dividends do not. Okay, so historically, RRSP room was a lot more important, just to make sure you're getting full advantage of any matching amounts that you could receive. It's a little less important now that matching is possible within the TFSA as well. And then the dividend, the big thing is just knowing that there's no tax withheld at source. So you're going to have to report that income at the end of the year and pay tax on it at that time. So most physicians, when I talk to them, I typically urge towards salary, although I have some in each. It's really up to the individual. But the main benefit I see with salary is eliminating big surprises. So it allows you to budget. You get a base salary amount every month. You can pick that amount up front, so and change any time, but it keeps you on a set schedule and eliminates surprises at the end of the year. Whereas with dividends, I've found that a lot of people lose track of how much money they're taking from the company. And then at the end of the year, they get the number and they find out what the tax bill is on that. And it's often a big surprise, and they don't always have the money available. So either one works, and I have clients in each, but I find salary is beneficial in that way. Okay, so we've kind of gone through high level kind of what the differences are between employee, self-employed, incorporation versus not incorporated, what to look out for throughout that process. Does anybody have any questions, either general questions for the group, or if anybody has specific ones, they can also reach out to me directly.
There are currently no open questions. Thank you, Sean. Are you able to share any common questions that you usually get from clients on incorporation, or any specific scenarios that you have in mind that would be helpful to go through?
Yeah, I mean, I think one big one would be a new doctor with a bunch of student loans. Now, the question comes, do I still incorporate if I am going to need to pull the money out to pay off the student loans? I've seen it go both ways. Part of it comes down to, I've seen physicians that just don't like the thought of having debt and want to pay it down as quickly as possible just to get it off their mind. Now, there are more tax efficient ways to do it, like paying it slower, but keeping you in lower marginal tax brackets. you're typically going to pay the interest obviously on the loan, but the tax savings may outweigh that. So just doing the calculation to find out what the ideal timeline to repay the loan is. But certainly that's going to be a factor in incorporation. The other one I often see is a new physician that is earning more money than they need, but they're planning on buying a house. So we want to have that conversation about where the down payment is going to come from upfront, because we don't want to necessarily get into a situation where we incorporate, you build up all the savings in the company, you're doing great with the deferral, and then you want to buy a house, so you pull everything out at once, because now you're going to have a big tax bill to pull all that money out. So we want to try and be as upfront with that as possible to know what you have in the coming up in the near future that could implicate or could change our plans. Those are, I would say, those are kind of the most common questions. Other ones, which also kind of brings up my comment right at the beginning, is I often get the comment of, oh, my friend says I shouldn't incorporate, so I haven't. And I've gone through that checklist with them, and sometimes they're right, it doesn't make sense to incorporate, but there's often times where it does make sense, and it could be just a simple difference in how much you're making or how much you need to live, and that just changes your whole calculation and your scenario from person to person. So it's not a one size fits all.
Thank you, Sean. So it's really important to look ahead and plan ahead.
Yeah.
And if there are no more questions, I would give everyone back 10 minutes of their time. So thank you, Sean, for taking your time today to present on this informative webinar about incorporation. And thank you, everyone, for attending this webinar.
Thank you for having me. And like I said, my contact information is there. Feel free to send me an email or give me a call if anybody has any specific or personal questions on their situation.